The Checkpoint is presented by GM Pharma, the first international multinational pharmaceutical company in Georgia. GM Pharma, to serve those who need it most.
A recent rating for Georgia states that a credible and effective policy framework and stronger governance indicators relative to BB peers underpins Georgia's rating. Let's start from here, and I will let you elaborate a little bit on this for our viewers and followers.
Certainly, thank you. Thank you very much. Yes, we affirmed Georgia's long-term foreign currency rating at BB on the 4th of February. And it is really governance and policy that are the key strengths for Georgia's rating. Our criteria places a lot of emphasis on governance. We have quantitative ways of measuring that through World Bank governance indicators, and Georgia scores well there. We also think you can see it in economic policy. We think particularly the National Bank has a strong, credible monetary policy. We also think the Ministry of Finance does a good job in managing public finances, and in both parts of the government are effective in managing what is quite a volatile external environment for Georgia. You know, Georgia's been hit by a number of shocks, be they from Russia, be they from Turkey, be they COVID related, and you do see resilience. And I think that the factor that would underpin the strength of policy in Georgia is just how quick international partners responded to the crisis. When the COVID kicked in 2020, you saw large commitments of support from international donors reflecting their confidence in the policy direction and the way that the country is run.
Thank you, Paul, for your comment. Alyona, what are some of the strengths connected to the financial sector of Georgia, and how does this sector fit into this overall general assessment of the rating for Georgia?
Mm-hmm. So the banking sector, its performance remains pretty strong. So the banks very quickly recovered from the crisis, from the pandemic. So we saw that in 2021, the sector return on average equity was at a robust 31%, and that is even above that of the pre-pandemic level. So this high and strong result was supported by the economic growth, by the acceleration of lending, but also to an extent by the recovery of some of the provisions which the banks, as you know, preemptively and massively created at the onset of this crisis. The banking sector also has quite good and strong solvency metrics. So the prudential capital ratios are now even above their pre-pandemic levels, and that was supported by the retention of dividends, by the moderate growth, and also, as I mentioned, by the very strong earnings. Yeah, and so we do expect that the performance of the banks will remain strong, and maybe it could normalize somewhat compared to the level of 2021, because we do expect that the loan impairment charges, the reserves, should return to their pre-pandemic levels, which is about 1 to 2% of loans. But in a nutshell, we do expect the performance to remain healthy, and it of course supports the Georgia's sovereign rating.
Thank you so much, and we will dig deeper a little bit into these points. The rating also says that risks to the GDP outlook remain on the downside. What could be the main driver of these risks? And Paul, you mentioned several. You mentioned COVID. You mentioned developments in Turkey and Russia, and also my emphasis would be this whole current situation with Ukraine. And
no, that's absolutely right. Yeah, you've really highlighted some of the main risks. I should say that our forecast for economic growth this year is 5.5%. So that's pretty strong performance. a lot of that will be driven by the continued rebound in the tourism sector. So this, again, is one channel where if you do see conflict between Russia and Ukraine, it's going to have a negative impact on tourism inflows across the region. And more broadly, we do see the potential for spillover from the Russia-Ukraine conflict to have a negative impact, both on growth, potentially on investment. It's also going to impact on financing costs. And you would see broader risk aversion towards emerging markets in general. And there has been an element of this already, and that would come through to the lari. So that would also affect potentially local currency financing costs as well, because that would also feed into inflation. We'd also have the issue around energy supplies. So again, if there are any disruptions to energy supplies from Russia to Europe, that will have a knock-on impact. Again, that will feed into inflation, which is one of the challenges in Georgia at the moment. These things that broadly, from that conflict, that would broadly impact emerging markets, you will find that Turkey is one of the emerging markets that's most vulnerable to those factors. And of course, Turkey's a big trade investment partner to Georgia. It's been noticeable actually that you saw a very sharp depreciation in the Turkish lira towards the end of last year, and the lari has actually been resilient to that. But we still think there could be more pressure from Turkey. They're trying to adopt a very unorthodox economic model, and we actually downgraded Turkey's rating last week. So we think the risks, the channels there, both from tourism but also from investment, from trade, are potentially negative. And then, yeah, just to highlight the pandemic, both again in terms of the pandemic, the need for new restrictions to be put in place that would impact the tourism sector, but also more broadly, these would have a negative impact on the economy. You know, when we look at the vaccination rates in Georgia, they're still relatively low, certainly for what we're seeing in terms of a BB rated sovereign. So those is the geopolitics and the virus that are the main risks to our economic growth forecast.
Yes, my small question to you before I go to Alyona and ask her how that affects the financial sector in Georgia is that, you know, at this point when the whole world is discussing what type of sanctions should be imposed on Russia, it makes sense to kind of like assess countries that are highly correlated with Russia's economy and, for example, less correlated. Where would you position Georgia in that respect?
It's certainly not as closely related as some other countries in the region, but there are important trade links, certain specific products where Russia is a big market, and Russia at the moment is a big source of tourism. If we think more broadly about the potential sanctions that could be put on Russia, then from our perspective, a lot of those are going to be on the banking sector, and so it have a more significant impact on the banking sector. And here, the connections with Georgia are a lot less.
I will let Alyona elaborate a little bit on your last point here. Alyona, please.
Yeah, maybe first of all to mention the geopolitical tensions. So today we haven't seen any direct impact of that on the Georgian banking sector. So the banks during the pandemic, they remained quite good access to international markets, to IFIs, and today we haven't seen any problems in the financing flows from the IFIs and from the foreign markets to the Georgian banks. On the tourism, yeah, so it remains quite a big challenge and a big risk to the Georgian banks, though the tourism sector, it comprises maybe less than 10 or maybe 5% of the total loan portfolio. So the tourism sector has not yet recovered to the pre-pandemic levels, and we do not expect it to recover this year. But anyway, the banks managed to quickly restructure their exposure to these vulnerable segments. as well as to the real estate and some others. Also, the direct support from the authorities in terms of various guarantees provided to these sectors and in terms of various subsidies. They also were pretty helpful in terms of reducing the debt burden of the borrowers, and as a result, the overall deterioration of the asset quality metrics at banks was far less severe than we initially expected.
But also these stimulus packages, do you think that helped, for example, currency stability in Georgia and also inflation? And what is your take?
From my perspective, then inflation is mainly caused from or derives from external factors rather than domestic factors. The one domestic thing you see in inflation at the moment is what we would call a base effect, which is because there were these freezes on certain utility prices and adjustments to utility subsidies at the end of 2020 and in early 2021. So as these drop out of the year-on-year inflation calculations, then this does have a positive impact on inflation. But more broadly, we see a lot of inflation that's come in just from higher food prices, higher international food prices, higher international fuel prices, and when we saw some fall in the lari as well. So that was passing through. So our sense is that inflation is going to ease this year. So our forecast for inflation, average inflation this year is 7%. We think some of these base effects will drop off. We think that tight monetary policy from the national bank will help to bring down inflation. We're also looking for more exchange rate stability this year, which would be supportive for inflation. Nonetheless, there is a risk, that high inflation starts to feed into wage demands and then feeds into inflation expectations, and actually means that inflation becomes more stubborn to bring down over the longer term. So it's something we're a little bit wary of, because clearly, inflation is very high at the moment. It's not something that's unique to Georgia, but when you look at the headline inflation numbers, then Georgia does look pretty high in the region.
So would you say that the NBG will maintain a tight monetary policy through 2022? And when do you see this fading out effect of high base effects that you just mentioned?
So some of the base effects will drop off, I think, in the second quarter, just from those specific subsidies that were put in place. So that will start to bring inflation down. But the NGB will look through that. So the national bank is obviously aware that these subsidies are going to drop out, and it's thinking more about inflation expectations. It's thinking about the potential for high inflation to put pressure on the currency. So our assumption is that it will keep policy pretty tight, and actually the tight policy has been supportive for the lari. So we think there will be some scope to ease policy towards the end of the year as you start to see inflation coming down. But yeah, we think they will keep monetary policy tight, and this is actually sort of a supportive factor for the rating. The response has been, we would consider it appropriate, and has had an impact clearly on the currency, which has helped contain the growth in inflation.
Since we're talking about the currency as well, what should be the approach of NBG to the external buffers, and also buying more reserves? Because what we read is that by Fitch's estimates, external buffers remain adequate at this point. It's 3.6 months of current external payments, but Fitch also highlights that this is below the current BB median, which is 5.6 months in 2021.
Yeah, so there are two different elements here. One is when you look at them on a stock position, and when you compare reserves against more or less any metric we think about. So in terms of liquidity, in terms of import cover, they're pretty low versus the peer group. However, if you think about the actual trend in reserves, then reserves have actually gone up. They went up last year, or up a bit the year before. And when we came into the pandemic, the one thing we were worried about would be real pressure on the external sector, because you see a big loss of receipts, big loss of tourism receipts. There wasn't necessarily anything that would compensate that, but because Georgia managed to benefit from all the donor support, then that enabled it to actually build up its reserves. And for us, it's encouraging that reserves have remained, have been able to go up slightly. I think it's encouraging. You've seen some increase in actual goods exports and revenues from goods exports. So the pandemic could have been a real pressure point for the external position and for reserve levels. But the trend that we've seen in the last couple of years for us is quite encouraging, and reflects again this policy framework, and reflects the willingness of donors to support Georgia. But when we step back and compare it against other sovereigns at the same rating level, then the external buffers are still low.
Now on the government's side, not to make our followers think that only NBG can improve the economic situation in Georgia, and that everything's on NBG. A very interesting phrase in the Fitch's rating is that Fitch expects a strategy of fiscal consolidation to resume once the pandemic shock subsides. Why two-digit economic growth is not sufficient to think that the shock has subsided already? And why not ask the government to actually start fiscal consolidation?
I think you can see some element. I think we need to differentiate what we mean by fiscal consolidation, because what you are starting to see is some of the specific measures around the pandemic that are being rolled off. But for us, that's not the same thing as fiscal consolidation. That's just taking away some of the pandemic related support. So fiscal consolidation, we would look to see broader measures, particularly broader measures to raise revenues. The government does have some ideas in mind. And broader measures to monitor expenditure growth. And also, one thing that's important the government's doing is looking at state-owned enterprises and reforming state-owned enterprises and reducing contingent liability risk from state-owned enterprises. So yeah, it's natural that obviously the deficit will come down just as the sort of extraordinary stimulus and support measures are removed. But I think we're thinking about a sort of a more medium-term approach to reducing the budget deficit. And this is something, the government has a good track record in the past of adhering to its fiscal targets. So we think that's something they should be able to do. We think, we hear that a new IMF program is close, and targets around fiscal performance and around the bringing down the budget deficit are likely to be embedded in that.
Thank you, Paul, for mentioning the IMF. I would like to ask this again, and want to hear your position. Would it give more confidence to Fitch if Georgia has this program with IMF, especially SOEs, and fundamentally reforming SOEs, taking away from SOEs this quasi functions that it has, that's on the agenda with IMF? Would that build more trust to Fitch in the sustainability of Georgia's economy?
I think it's helpful. Georgia has a long track record of reform, and it has a long track record of cooperation with the IMF. Our sense is that we've had this delay between IMF programs. It hasn't really impacted the policy direction of the government, but the IMF program is supportive in terms of underpinning the reform agenda for Georgia. So we think it's helpful. We don't, it's not that if an IMF program wasn't there, we wouldn't anticipate any kind of reform but we think it's helpful, and again, it's something that foreign investors look at, and they consider adherence to an IMF program to be favourable.
One more interesting phrase in Fitch Ratings is that medium-term spending pressures remain high on the back of an ambitious government infrastructure plan. What does Fitch have in mind while talking about the ambitious government infrastructure plan? And then I will build up with this new initiative that came from the Prime Minister recently.
Yeah, so I mean, when we speak to the government, we talk about the capital spending, and capital spending is set to be around 7 to 8% of GDP in Georgia, and that's high, you know, versus the peer group that's quite high. We think, you know, capital spending in itself is generally a good thing, depending on the sort of quality of projects that are executed, and you know how cost effectively the projects are executed, and there are clear infrastructure needs in Georgia. So we think that can be supportive, but we say ambitious just because it's quite a high level of capex. You know, to execute that amount of spending is actually quite a challenge. So this is something that would be long-term supportive for growth, but the actual execution can be a challenge.
Yes, I understand, and I'm asking this because the Prime Minister has talked about this big infrastructure plan just to support both probably the banking sector and also the construction sector as well, which is the weak point in the overall economic growth, so that it can boost both the employment and also help these sectors. I want to go to Alyona with this question. How would you assess this decision for banks? Because what we hear from the Prime Minister is that right now there's a lot of capital in banks that needs to be spent.
I could argue with you that banks do have quite sizable capital buffers to spend on growth, because so the new capital requirements that the National Bank postponed during the pandemic, they are now being gradually phased in, and actually the National Bank expects almost all the banks to be compliant with these higher requirements in 2022, and the two largest banks have already mentioned that they are just compliant with that. But the banks still need to build some, like management buffers against these requirements, and it will take time to do that. And we expect that the lending growth this year will be about 10 to 15%. And as we understand, the banks are primarily targeting the retail and the micro segments to help maintain their margins, because the yields in these segments are higher than in the corporate sector.
Sorry for interrupting, Alyona, but would Fitch say that currently there is this excess liquidity in banks in Georgia? Because that's the main argument at this point.
The liquidity is sufficient in the banking sector. That is true, but it doesn't mean that all this liquidity could be utilized for lending. So that's the point. But definitely, yeah, the banks do have capacity to issue construction loans, to issue longer-term corporate loans, a part of the retail and other segments. But they still need to build some capital buffers against the minimum requirements, and to be comfortably compliant with the prudential minimums.
This will be my last question, and I would like for us to sum up our conversation. And I know that you are not issuing like specific recommendations, but I would like you to say what Fitch sees as the main priority that both National Bank and the government should focus on in order to maintain the stability with the rating and to improve it further potentially.
I think you actually almost answered that question yourself there. The main priority is maintaining stability in what's a particularly volatile environment at the moment. I mean, when we think about the rating, you know, we identify what could be positive for the rating and what could be negative for the rating. And in terms of the positive things, then one is just stronger and more sustainable growth and this reduction in dollarization. That means we feel more comfortable with the growth model. The other thing that's positive for us is just a reduction in external vulnerabilities, and that would come particularly from a narrowing of the current account deficit. The negatives, we've talked about a couple of those. Obviously, the impact of geopolitics and domestic politics to some degree on economic growth and on economic policy making. Also, if government debt were to continue to rise, that's something we would view negatively. And a final thing is if we saw a further increase in the current account deficit, we saw a continued drawdown of reserves, which we've said are already relatively weak, then that's something that we would view negatively.
Thank you. Alyona, please.
Yeah, so for the banking sector, the main positive things would be the reduction in dollarization. I think that's the main point. And this is why we rate the largest Georgian banks still one notch below the sovereign level. So this is the main thing. Also, there are some event risks linked to the potential further pandemic issues. This is not our base case, but anyway, this could be the negative aspects here, the negative sensitivities for the credit ratings of banks. If this led to some deterioration in asset quality metrics and profitability of the banks, that would be credit negative, of course.
The Checkpoint is presented by GM Pharma, the first international multinational pharmaceutical company in Georgia. GM Pharma, to serve those who need it most.